Hey guys, I'm Phil Town from Rule 1 Investing, and today I'm going to tell you all about the bad investing habits you need to leave behind in 2020. All right, so here comes 2020. It's a great time for a fresh start, not just the start of a new year, but the start of a new decade. Could be a crazy year, could be a crazy decade. There are going to be all sorts of significant, unpredictable, political, economic, all kinds of events are on the horizon. We don't know. We just know it's going to be exciting. So whatever happens to the economy in 2020, though, we want to be able to benefit. And you can become a more successful investor if you just think back on what you're doing in 2019 and ask yourself this: did you have any bad investing habits? Well, now would be a great time to break them, don't you think? So let's do these things. Let's do a little bit of investigating on 3 really bad habits people have. And then if you can get those straightened out, you're going to be off to a great start in the new year. The first bad habit is putting off retirement planning for another year, right? Oh yeah, I'll do that later. You got to stop that, you guys. Another year came and went. Have you started planning for retirement yet? No. Well, people are living longer now. People are healthier than they ever used to be in history. And you've got to be prepared for a retirement that could last 20 years or longer. 30 years is not uncommon, right? Into your 90s. You may have heard that saving $1 million is a good goal for a retirement nest egg. $1 million. You know how many people have $1 million? Not very many. But guess what? Even if you had it, it probably isn't going to be enough. Isn't that nuts? In reality, the average person who right now is, let's say, 45, 50 years old, you're going to need to save about $2 million in order to have a retirement where you can live on, let's call it $30,000 of Social Security and another $50,000 from your retirement portfolio. That's an $80,000 lifestyle in today's dollars. That is not living rich, but it's an okay, you'd get along okay. You and your wife, you and your husband get along okay on 80 grand between Social Security and your retirement portfolio. Now, $2 million sounds like a lot of money, you guys, but guess what? It's not gonna last. By the time you get to retirement, if you're 45 right now, 20 years from now, that $80,000 lifestyle is going to cost $150,000 just with the inflation rates we have right now, and we're hardly experiencing inflation at all. So if we get to historical inflation, it's going to get even worse. So here's the deal. It might sound like a lot of money, okay? Getting to $2 million sounds crazy. Most people don't even have $200,000, but it's easier than you think it is. As long as you start investing as soon as possible and you invest like the best investors in the world. If you haven't already started, I want you to get started now, okay? I want you to do the first thing you got to do to be a good investor. Learn to be a good investor by having good investment strategies that have worked through depression, world war, inflation, stagnation, you name it. And these investing strategies have been successful for the last 90 years. You can do this, you guys, but you got to follow the best investors in the world. And the earlier you begin planning for your retirement, the more time there is for those investing strategies to explode and do wonders on your portfolio. Now, this all assumes that you're going to get good returns, right? Because you're implementing these great strategies. If you just go the way everybody's telling you to, which is you stick your money in an index fund or a mutual fund from your 401k, I hate to tell you this, but your money isn't going to grow as quickly as it should. It's not going to grow perhaps even as quickly as people think it will. See, just to put this in perspective, if you listen to the people who are out there talking about the stock market, you'll think that the stock market is just going gangbusters, right? 20% last year on the S&P 500. Well, it's not. This is just a bunch of hype. If you put your money in the market in January of 2018, just a little over 2 years ago, you would have about a 3% return. 3% return. So guess what? The stock market is fully capable of growing at 5%, 3%, 0% for the next 20 years. And if you just put your money into the market in general, you're in trouble when it comes to financial retirement. And if you want to put your retirement nest egg into a savings account, good luck seeing any kind of return at all in today's low interest environment. So guess what? You can't put it into bonds and hope to be, successfully retired. You can't put it in a savings account, hope to be successfully retired. You can't trust the stock market as a diversified portfolio market to give you a good return over the next 20 years. So the solution isn't to just stick your head in the ground, it's to invest in wonderful businesses when they go on sale. Follow the best investors in the world. Picking up good companies to buy and waiting until you have a great price is the best way to make your money grow over the long term, and that's how you are going to manage to get to a secure and happy retirement. Okay, next bad habit. You're adding debt. You are seriously? You know better than this, right? But you just couldn't stop yourself at Christmas. You added more debt last year. Now, guess what? If you owe money on your credit cards and you have missed a payment or two, your credit card obligations have shot up to approaching 20% per year. That means that if you just get rid of that, you're making 20% a year. My gosh, you guys, that's a fabulous rate of return. So the first thing to do is get yourself out of that high-end credit card expense. You got to do that right away. Stop adding debt and start getting rid of those 18 to 20% payments that you're making. It's horrible. Right now, U.S. credit card debt's gone up 6% in the last year. And the average household right now owes almost $7,000 on their cards. So this is a really scary trend, and it's preventing many of you from becoming wealthy. You are using the technique of anti-compound interest. Really not a good idea. So I want you to promise yourself that you won't get deeper in debt. At a minimum, you won't add any debt in 2020. And then next, get rid of the high interest rates on these cards. This high interest rate can make the debt spiral out of control. So if you're going to promise yourself no extra debt, then what you've got to do is you've got to get those payments bigger and knock that down. Or you're going to end up getting, all of your money going out to credit card companies and banks. So vow to stop that cycle this year and just say no to more debt and get rid of that expensive 20% debt. Get rid of that. That's the first thing. And now to do that, you got to get rid of the habit of making only the minimum payments on your cards. Don't do that. You look at the print on your credit card statement, you'll see that if you just pay the minimum, you are hardly going to make a dent in the amount you owe. It could literally, this is mind-boggling, but it's true. It could take you decades to pay this all off. And you're going to pay a tremendous amount of interest. And that's money down the tubes. That's your money to retire on. That's your financial freedom, you guys. So I want you to stop that and get rid of that high-end debt. Okay, enough said. So the final investing habit that many of you have that I want you to break in 2020 is the toughest one of them all, okay? And that is the habit of just following the mob in and out of the market. This is a terrible habit. What it is you go into the stock market because everybody knows the stock market is the way you put your money in when you want to build a retirement account. And when the market starts to go down and goes down and goes down and goes down, when it goes down after 6-8 months of going down, the pain is so high that you follow everyone out of the market, right? So this is a terribly difficult habit to break because in order to break it, you're going to have to reset what's going on in here between your ears. You're going to have to stop being a speculator in the market. Speculators buy when the market's going up, and after it's fallen down to the bottom, they sell. So essentially what speculators do is they buy high and they sell low. In 2008, 2009, what happened to an awful lot of people is they were buying in because the market got hot in 2006 and 2007. And then when the market went down like a brick, down into 2009, that's when they got enough pain that they sold at the bottom. And then they didn't buy back in for years and years and years. And now they're buying back in because the market's really up here. It's been going up for a long time. They're going to buy back in up here. And as sure as I'm sitting here, according to the emotional rule of investing, As soon as those people buy in, this market crashes. In order to make money in the market, you have to have cash when there's this economic storm. You have to be in cash. So you're going to effectively start to learn how to do almost the opposite of what everybody else is doing out there. So if everybody's buying and you feel this kind of sense of greed in the market, this sense of, hey, it's just going to keep going up forever, interest rates are going to stay low forever, it's all going to go up forever. When you feel that, when everybody's telling you how much they're doing, how much they made, you guys, you want to be out of there. And when you feeling in the marketplace, when you feel that everyone's saying, what a terrible, you'd never invest in the stock market, the fear is very high about investing in stocks, that's when you want to be doing it. You want to be investing then. So you're going to have to teach yourself how to be a bit of a contrarian. Now, one way to do this that I really like is that you just pay attention to what Warren Buffett and Charlie Munger are talking about. Google them, watch the news. If there's something on CNBC where they're talking to Warren Buffett, listen to the guy. He's already said a couple of years ago, we're just about to have an economic storm. And when that happens, you better get your bucket ready. And what is that? Your bucket's cash. So go out and get that cash ready, you guys. I mean, I can't give you advice here. This is just education, right? And I hope it's entertaining education. But at the end of the day, I'm not your advisor, but my opinion is this would be a good time to start getting the cash right now. You might be in cash for another 2 or 3 years, and yeah, the market might keep going up, but boy, when it drops, you're going to be ready to take advantage of it. There's a lot of uncertainty ahead of us right now. 2020, man, we got an election year. You know how that's going. Going to be a great year for the history books. I promise you that. One political event after another is going to happen. We got the impeachment going on. We got Democratic primaries going on. We got this thing going on with Iran. We got stuff going on with China, right? I mean, this is going to be a crazy, crazy year, and who knows what will happen with all of that. So on top of all this turmoil, the stock market is breaking these records. It's going higher than ever before every day. This is so exciting. So you guys, the current bull market has lasted more than 10 years, more than, geez, I mean, we've used to have an average of about 5 years where there would be some kind of a 20% correction. Now it's been over 10 years since we've had one, and we are way overdue. Some of the best investors I know, including Ray Dalio, think that what's coming is more than just a recession, that it's an incredible, once every 85 to 95 year kind of a change. So this can be a time where you will deeply suffer over the next few years, or you will get rich, depending on what is going on with your ability to follow the best investors in the world. So you've got to be disciplined. You've got to know what you're doing. If the market starts to plunge, you've got to be able to stay out of it and be unemotional. Watch other people panic. Watch all the fund managers selling out. So if that happens, you just got to be disciplined. If the market's crunching down, people are going to be very emotional about it. These are baby boomers losing their retirement. They're going to freak, right? And you are absolutely going to be affected by that. So I want you to be prepared for that emotionally. I want you to get yourself to a cash position, get the bucket ready way early so that you're not sitting there with the market down 30% trying to figure out what to do. If this market goes down, I want you to just sit there in cash. Avoid watching the talking heads telling you how it's going to turn around and go back up and you should jump into it. Just wait until the companies on your watch list that you've been putting up there that are wonderful get to the price you want to buy them at. You don't care what the market's doing. What you care is that collapse in the market prices is going to bring you great companies at a great price. And if you buy them at a great price, then you hold. Then you don't worry that they're going down another 50%. What you do then is you go out and find some more money and buy more of them. So the only thing you should be doing after you step back into this market is just waiting for more opportunities to buy those companies on your watch list and buy more of them if they sell at an even steeper discount. The point of this is really important, that if you're getting a $10 bill, if you're buying $10 of value and you're paying $5 for it, you should be thrilled that you did that. And then if you can buy more $10 bills at $2 or $1, man, that doesn't mean your first deal was a bad one, right? So you buy more, buy as much as you can. So if you can break these bad investing habits, you guys, that have kept you back in the past, I'm going to tell you right now, You should be looking forward to a phenomenal, successful year this year. Not this year, next year, but you're ready this year, no matter what happens in this economy. You're gonna be on the right path to growing your wealth. You're gonna be on the right path to becoming financially free. It's so exciting to do it. And then you get to have a great worry-free retirement. Now, I'd love to hear from you guys. Have you been practicing any of these bad investment habits? Leave a comment below with your answer. I'll be sure to follow up with you. Thanks for watching. Now go play. If you enjoyed this video and feel it was valuable in teaching you more about bad investing habits that you should leave behind in 2020, hit the like button and please share the video with your friends. And if you want more investing content, just subscribe to my channel. It's full of good stuff. And don't forget to click the button on the screen. We'll get you a free gift. And thanks again for watching.